Welcome to this explainer. Look, right now the financial landscape feels, well, a lot like the Wild West. From the explosive rise of artificial intelligence to these crazy macroeconomic shifts, we're all facing this massive, relentless wave of new information and incredibly complex financial products hitting the market every single day. To navigate all of this safely and effectively, you really need a trusted professional advisor's perspective. Which brings me to a question that honestly would have sounded like pure science fiction just a few short years ago. Would you let an AI manage your life savings or bet your entire retirement on a coin toss? Sounds extreme when you phrase it like that, right? But the reality is, these new financial frontiers are tempting everyday investors to take unprecedented risks with their hard-earned money. Just look at this staggering number, 200 million. That's how many people are using ChatGPT every single month. But what's really fascinating here is that a massive chunk of these users are already actively seeking financial, budgeting, and investment advice from the platform. They're literally trusting an algorithm with their most sensitive data. Okay, let's dive into this. Here is our roadmap for today. We'll start with the modern investing landscape, navigate AI financial advice, expose the prediction market mirage, objectively assess macro government funds, and then wrap up with some actionable steps for your portfolio. All right, Section 1, the modern investing landscape. Today, it feels like everyday investors are trying to drink from a fire hose of complex noise that desperately needs filtering. You hop on social media and you've got unregulated TikTok gurus promising you can 10x your money in 6 months. Then, over in the institutional space, we're seeing rising defaults and frozen withdrawals in these massive, totally opaque private credit funds. Zoom out even further, and you've got global tariff shifts and macroeconomic volatility creating a seriously unpredictable environment. Moving on to Section 2, navigating AI financial advice. So OpenAI is actually piloting a $200 a month finance-focused window. But if we impartially compare an AI assistant to a human fiduciary, the trade-offs become pretty clear. On the AI side, the accessibility is absolutely incredible. You have 24/7 access and, hey, zero fear of judgment. But, and this is a massive but, there is no fiduciary duty. The AI isn't legally required to act in your best interest. Plus, the hallucination risk is very real. I mean, sometimes these advanced models will confidently tell you there are zero-letter E's in the word 17. Now, on the human side, you get real accountability, emotion management, and holistic planning, though, yes, typically at a higher traditional cost. And this brilliantly illustrates why AI is just so tempting right now. As one expert pointed out, it's a lot like how people are totally willing to Google their most intimate medical symptoms before they ever see a doctor. People feel incredibly comfortable sharing vulnerable, highly sensitive financial data with an AI, mostly because there's absolutely no one on the other side of that screen judging their spending habits. But here is the absolutely critical takeaway. You have to treat AI as a powerful tool, not a registered fiduciary. Large language models are, at their core, language prediction models, not judgment models. They're basically just stringing words together based on training data, not conducting deep, nuanced financial research for you. On top of that, exactly how you structure your prompt can drastically change the output you get. Relying on it blindly is super dangerous. Verifying the math and the reasoning, that's mandatory. All right, Section 3, the prediction market mirage. Now, what's really interesting about this is the harsh mathematical reality hiding behind the hype. Platforms like Polymarket and Kalshi are absolutely exploding, letting users bet on literally anything, from political elections to celebrity breakups. But despite the promise of cashing in on your unique insights, blockchain analysis shows that 84% of retail users on these platforms realize losses. Think about that. Only 16% actually manage to break even or turn a profit. We really need to call this exactly what it is. These are binary options with a 100% downside risk. We're seeing rampant insider trading and market manipulation, which leads to a median retail ROI of -8%. That's actually worse than traditional legal sports betting. And honestly, the most concerning part? This gamification is being heavily pushed by aggressive marketing that specifically targets young users. Make no mistake, this is gambling. It is not investing. Let's pivot to Section 4, assessing macro government funds. It's important to realize that massive state-level financial moves can directly impact you as an everyday taxpayer and investor. To really understand this, let's quickly define a sovereign wealth fund. Basically, it's a state-owned investment fund that invests in real and financial assets, usually designed to preserve and grow wealth for future generations. For example, countries like Norway have built massively successful ones funded by nationalized oil surpluses. Well, Canada recently proposed its own $25 billion Canada Strong Fund. If we look at this impartially, the pros include potential economic stimulation for infrastructure, the unique ability for retail investors to actually co-invest, and leveraging the government's low cost of capital. But the cons? They are steep. Unlike Norway, Canada runs a budget deficit, which means this is essentially a sovereign debt fund. It also carries 100% domestic concentration risk and massive execution risk. And that last part is highly relevant when you look at Canada's history of multi-billion-dollar cost overruns on pipeline projects. We see a very similar need for strict impartial financial evaluation when looking at the economics of Alberta separatism. Now, proponents point to some strong fiscal arguments. The province is a net contributor to federal transfer payments, they claim a high estimated share of the Canada Pension Plan, and they want relief from federal regulations. But on the flip side, the frequently overlooked costs of secession are astronomical. Pulling this off would mean funding an independent military, entirely replacing federal programs and bureaucracy, and facing significantly increased debt servicing rates on global markets. So the crucial point here is this. Macro-level government promises, whether we're talking about a new wealth fund or an independence movement, almost always carry massive hidden costs and execution risks for the everyday taxpayer. As citizens, we absolutely must objectively scrutinize these macroeconomic promises with the exact same rigor we apply to our own personal investment portfolios. Which brings us to Section 5, Actionable Steps for Investors. Consider this your advisor's blueprint for protecting your personal portfolio. To cut through all this modern financial hype we've been talking about, you need to follow 3 fundamental rules. Step 1, treat AI as a capable assistant, not a verified advisor. Step 2, strictly separate your gambling money from your actual investing money. And Step 3, scrutinize all macroeconomic promises impartially. Take the emotion out of the math. Let's get really practical here for a second. Beware of any social media promises of 10x returns in 6 months. Honestly, they are mathematically improbable. Ignore the lure of those prop trading firms. Most of their revenue actually comes from the qualifier fees that are designed for you to fail. Don't base your long-term investments purely on whatever the near-term news headlines are screaming about today. And ultimately, build your wealth by owning diversified, productive assets, not by chasing trends or just sitting on a pile of cash. It's all about bringing your focus back to the true goal of wealth management. Real investing is about long-term growth. It's about achieving peace of mind. It is absolutely not about chasing the next dopamine hit or gamifying your life savings on some prediction platform. As this Vanguard poll perfectly highlights, peace of mind remains the top reason people seek out advisors. Emotion management, behavioral coaching, and holistic planning. Those are the true, enduring values of a solid financial plan. An AI algorithm or a binary betting market simply cannot provide that level of security and peace of mind. So, as we wrap up this explainer, I want to leave you with a critical question to evaluate your own setup. Does your current financial plan genuinely give you peace of mind, or is it secretly keeping you up at night? If it's the latter, it's time to take control. Prioritize stability over those fleeting trends. Seek verified, registered fiduciary guidance to build a secure, long-term plan tailored specifically to you. Thanks so much for joining me for this explainer. And hey, stay focused out there.